Thank you for the introduction. Good morning, everybody. Since this is the first time I present to you on the Hong Kong and China stock market this year in 2022, so may I wish all of you a very happy and successful new year. Today, I will share with you our Hong Kong and China stock picks, as well as some key discussion points. Our key discussion points today will cover a review of China and Hong Kong stock market, overview of China's economy and the 2022 outlook. We'll also try to look for answers to some most frequently asked questions, such as will the Chinese yuan keep rising? Is China's anti-monopoly policy getting tighter or more relaxed? And the impact of delisting of China concept stocks in the US on the Hong Kong market. And most important of all, we'll also try to analyze if Chinese stocks can rebound in 2022. And finally, we'll share with you our ETF and stock picks. Okay. For the China A-share market, 2021 was a lackluster year. The Shanghai Composite Index was up only 4.8% last year, and the Shenzhen Component Index was up even less, 2.67% in 2021. And the Chinex fared better, slightly better. It was up 12% in 2021. The Hong Kong market was fared very badly last year. The Hang Seng Index was down 14% in 2021, and the Hang Seng Tech Index was down 33% last year. Reasons for the lackluster performance. First of all, China being the first major economy to normalize monetary and fiscal policy to cope with the pandemic. So given a healthy recovery, liquidity was not as loose as 2020. And secondly, China's early and sustained economic recovery from the coronavirus was reflected in a strong performance by the CSI 300 Large Cap Index, which rose 27% in 2020. Compared to 16.3% rise for the S&P 500 in 2020. So it's natural to see that after a banner year in 2020, the A-share market consolidated and corrected in 2021. And thirdly, the valuation of some market favorite growth stocks, as well as some thematic stocks, had become expensive. So it became difficult for the market to move further up in 2021. As you are well aware that Beijing stepped up regulatory scrutiny of leading internet companies that dealt a heavy blow to the tech companies, internet companies listed in Hong Kong. On the other hand, the US SEC said it would begin to implement legislation to delist US-listed Chinese companies that do not comply with US audit requirements. That also trigger a sell-off among the so-called China concept companies, China concept stocks listed in the US. Finally, the real estate sector has been hit by a debt crisis. There's concern about default because some developers missed interest payments while others defaulted on their debt altogether. Okay, but in a lackluster market, there are still outperforming sectors that shine. For instance, electric equipment, non-ferrous metal, gold, coal, because of the power shortage and robust demand for coal and basic chemicals. These sectors outperformed last year. Well, underperforming sectors include household appliances because the rise in raw material prices will add pressure on the gross profit margin of household appliances manufacturing, and also non-bank financial because of the credit crunch, and properties also a victim of the credit crunch. Okay. 2021 can be viewed as a year of normalization for China's GDP, earnings growth, financial markets, and policy, everything after the preceding pandemic disruption. So we witnessed normalization of economic growth as well as earnings growth and the financial markets, and also government policy. And after a strong rebound in the first half of 2021, economic activity in China cooled rapidly in the second half of this year, of last year. We projected real GDP growth to reach 8.1% in 2021, surpassing the government's 6% target, but it will moderate to 5.1% in 2022. Okay, as for 2022, we expect a pause on tightening because of the further slowdown in economic growth, as well as the new outbreak of COVID Omicron in various parts of China. So we expect China has started to ease both monetary and fiscal policies. On Monday this week, the PBOC announced that it will lower the borrowing cost for its medium loan facility, the so-called MLF lending rate, by 10 basis points from 2.95 to 2.85. This is the first time it lowered the MLF interest rate since April 2020. And on the same day, the PBOC also lowered the borrowing cost of its 7-day repos rate. Besides pause on tightening and also lowering interest rates, we expect more relief for the real estate sector. Actually, banks have been told to increase mortgage loans and lower lending rates, while some cities are relaxing property purchase restrictions. On the export side, on the trade side, China exports remain strong in 2021, and we expect exports to stay strong this year because of favorable foreign demand driving strong trade growth, as well as global coronavirus restrictions could continue to benefit China's shipments of electronics and pandemic-related items. However, there are certain headwinds the economy is facing this year. For instance, US-China relationship will remain competitive. However, we do expect increased dialogue between the two countries and a more predictable approach adopted by both countries may lower tail risk and uncertainty. Other downsides risks also persist. For instance, renewed domestic COVID-19 outbreaks, including the new Omicron variant, could lead to larger disruptions in economic activity. So we are hearing lockdowns in different cities in China, including Xi'an and Tianjin. Okay. The yuan was up 2.6% against the US dollar in 2021 after the sharp rally in 2020. The yuan remained strong against the US dollar in 2021, and it was the best performing major emerging market currency in 2021, while its trade weighted value against major trading partners was at 6-year highs by gaining more than 8%. So will the Chinese yuan keep rising this year? The answer is yes. We are upbeat on the yuan this year because stronger capital inflows to China on higher rates, more muted inflation, and underinvestment in yuan assets by global investors will be the fundamental factors supporting the yuan. And a new global COVID-19 resurgence may delay China's border reopening, underpin its balance of payments, BOP strength, And additionally, the sizable current account surplus will provide sufficient buffer for the yuan, even if the US dollar strengthens because of the expected rate hike by the US Fed. And most importantly, the Chinese authorities appear broadly comfortable in allowing the currency to appreciate. So we don't see much intervention from the government to curb the rise of the yuan. So we expect the yuan to appreciate to between 6.2 and 6.3 against the US dollar this year. And we expect also solid support for the yuan against the US dollar around 6.4 to 6.42. Okay. Another most frequently asked question is China's anti-monopoly policy. Will it get tighter or more relaxed because it affects a lot of the internet, a lot of the tech companies? The answer is a bit disappointing because the State Administration for Market Regulation, the SAMR, has already stated that it plans to further tighten enforcement of antitrust and anti-unfair competition rules in 2022 in key areas such as the platform economy, technological innovation, and information securities. So tech companies, online gaming, online platforms, private tutoring, and cryptocurrency will continue to face government scrutiny and become the casualties of this tightening of anti-monopoly policy. So we don't expect a lot of upside among the tech stocks. It may rebound because they were oversold, but we do not expect a lot of upside because of the lingering policy, unfavorable policy towards the sector. Okay. And then what will be the impact of inflow of Chinese companies to Hong Kong? On December 2nd, 2021, the US SEC adopted the final rules of the Holding Foreign Companies Accountable Act, and the implementation means as of 2022, if the PCAOB fails to review the issuer's accounting firm for 3 consecutive years, the stock will be banned from trading on the national exchange and will be mandatorily delisted from the US stock market. That is until 2025. The tightening of overseas regulations, coupled with the gradual liberalization of Hong Kong stock market listing rules and index inclusion, we expect it will accelerate the return of Chinese companies eligible for listing on the Hong Kong stock market. Some may go back to the motherland to get listing on the Asian market, but we do expect majority will seek listing on the Hong Kong stock market. But how it will impact the Hong Kong market, there are diverse opinions. Some believe this will put pressure on the liquidity of the Hong Kong capital market because the Hong Kong market is far smaller than that of the United States, and their return will generate financing demand on a large scale and may create a strong so-called bloodletting effect, straining the Hong Kong market. However, some believe that the big names relisting in Hong Kong will lead to hundreds of billions or even trillions of dollars flowing back to Hong Kong, which will inevitably strengthen Hong Kong's position as Asia's financial center. We think both beliefs are valid. On the short term, we do concur that the return of those companies in the US may have a negative impact on the Hong Kong market because of financing demand. But in the longer term, it will benefit Hong Kong, as I've mentioned just now, that it may attract trillions of dollars fund flow back to Hong Kong, which will strengthen Hong Kong's position as Asia's financial center. Okay. Can Chinese stocks rebound in 2022? Okay. Actually, now valuations of the A shares are quite attractive relative to global equities. The left chart shows the 12-month forward PE, price to earnings ratio, of the CSI 300, the light blue line, and the dark blue line represents the MSCI China index. So now the components, the constituent stocks of CSI 300 are trading at less than 14 times forward 12-month forward PE. And the China MSCI China index is trading even lower at around 13 times 12-month forward PE. CSI 300 is 13.7 times PE, 0.5 standard deviation, whereas the MSCI China index is trading at 13.2 times 12-month forward PE, as compared to the peak of 18.6 times PE for the CSI 300 and 17 times for the MSCI China index. So now valuations are getting cheaper. And compared to global equities, we here you see three lines, different color lines. The light blue one represent MSCI versus the MSCI China index versus MSCI ACWI index. That represents the 23 developed markets and 29 emerging markets, the large cap companies in 23 developed markets and 29 emerging markets. Is trading this this black line is the MSCI versus S&P 500. It's trading at a 42% discount compared to S&P 500 and 28% discount compared to MSCI ACW index. And this as for the internet companies, China Internet are trading 18% discount to US internet companies. Okay, so China is cheap to conclude, but we do not expect quick rebound in the short term because of lack of catalysts, strong catalysts, as well as concern about other headwinds that I will talk about later. Okay. So what is our ETF pick? We in the past we recommend China A50 as well as CSI 300 index ETF. Now this time round we have a new ETF to recommend. That is the MSCI China A50 Connect Index ETF. Let's take a look at the index first. The index seeks to represent the performance of the top 50 large cap China A shares listed on the Shanghai and Shenzhen stock exchanges and accessible through northbound Stock Connect using a sector neutral approach. How the constituent stocks are chosen, we can take a look at this chart. So MSCI, the index company, starts with the parent index, that is the MSCI China A index. And from the parent index, MSCI will select 22 large cap stocks, 2 from each sector. And there are a total of 11 GICS sectors they will choose from. So 2 from each sector will come up to 22 large cap stocks. And they will choose those with the biggest index weight. And then the MSCI will select the remaining 28 because the A50 Connect Index comprise of at least 50 constituent stocks. So the remaining 28 will be selected from the large cap universe with highest index weights, also from the parent index, the MSCI China A index. The last step is MSCI will apply market cap weight within sectors and normalize sector weights to equal those of the parent index. So it will achieve diversified weighting, and the rebalancing will be quarterly. And there's also turnover mitigation to ensure that the constituent stocks are the most liquid ones. So this is how the constituent stocks are selected. Okay, this is a comparison of the sector weights of the MSCI China A50 Connect Index with the other three indexes, namely FTSE China A50 Index, CSI 300 Index, and MSCI China A Index. One notable difference is for FTSE China A50 Index and CSI 300 Index, these financials, the financial sector occupy a high percentage of the sector weight. In FTSE China A50 Index, it accounts for almost 40% of the index. And CSI 300 Index, it accounts for around 25%. Besides that, this is consumer staples, also accounts for a big portion of the index weight, 27% for FTSE China A50 Index and 14.8% for CSI 300. But for MSCI China A50 Index Connect Index, the financial sector occupies only less than 20% sector weight. So it's less concentrated in financials, and consumer staples occupies less than 20%. What sector has increased? That is the blue represented by the blue color here. That is healthcare, 10.6% from 5.85% and 9.4% in the FTSE China A50 Index and CSI 300 Index. And this is information technology, also accounts for a bigger percentage, accounting for 14.8% as compared to only 3.8% in the FTSE China A50 Index, and also slightly higher than the 12% share in the CSI 300 Index. So we reckon that the MSCI China A50 Connect Index is more diversified, more balanced, and less concentrated in financials and real estate, as well as consumer staples, and has a higher weighting in healthcare and in IT. These are the top 10 constituents of the A50 MSCI A50 Connect Index. Contemporary Amprex Technology (CAT) accounts for nearly 10%, followed by Guizhou Maotai, Longji Green Energy, China Merchants Bank, Wanhua Chemical Group, BYD Company, Luxshare Precision, China Tourism, Yunnan Energy New Materials, and Wuliang Ye Yibin. So it's quite diversified. Okay, here I share with you the index performance of the MSCI China A50 Connect and MSCI China A and CSI 300 and FTSE China A50. So very clearly, it shows that the MSCI China A50 Connect Index outperformed the other three indexes by quite a big margin. You can see that over 5 years, the MSCI China A50 Connect Index rose nearly 100, nearly double, rising 100% as compared to 51% gains on the MSCI China A Index and 47% gain on the CSI 300 and 61.2% gain on FTSE China A50 Index. If we look at a shorter horizon, 6 months also, the MSCI China A50 Connect Index outperformed the other three, except MSCI China A in the last 6 months. It was down 2.7% in the last 6 months as compared to 4.2% drop and 8.4% drop for the CSI 300 and FTSE China A50 respectively. Okay. There are three MSCI A50 Connect ETF to choose from, which are listed on the Hong Kong Stock Exchange, namely the one managed by China Asset Management, CAM MSCI A50. The stock code is 2839. It has the largest fund size. AUM was 1.36 billion as of 12 January 2022. The other two are namely CSOP MSCI A50, and the stock code is 3003, and eFund MSCI A50, the stock code being 3111. AUM of the other two ETFs are more or less around the 600 million to 800 million range. And ongoing charges, you can see clearly CAM and MSCI A50 is the cheapest among the three. Replication method are the same, using physical replication, and the dividend policy. This is a dividend policy. CAM MSCI A50 and the eFund MSCI A50 ETF will declare any dividend annually if there is, if any. But for the CSOP MSCI A50 ETF, is non-guaranteed. Okay. So we based on a larger fund size and cheaper ongoing charges, we recommend CAM MSCI A50. Since listing, its price has been trending down, which we think is a good opportunity for investors to accumulate at lower levels. If it continues to trend down, we recommend to buy at 30.5 Hong Kong dollars, and our preliminary target is 33.5 Hong Kong dollars, and we recommend cutting loss at 29 Hong Kong dollars. Okay. Now let's come to stock picks for 2022. We witnessed explosive growth in new energy vehicle sales, NEV sales. Sales of NEV in China reached around 3 million units in 2021, surging about 170% year on year. And for this year, NEV sales are expected to hit 5.5 million, almost double again in 2022, and climb to as high as 20 million by 2030. EV penetration is going to be crucial if China is to meet its goal of achieving carbon neutrality by 2060. So it's in China's favor to push to boost EV NEV penetration. If NEV sales can account for half of all new auto sales by 2030, then emissions from cars, excluding those produced during their manufacture, will peak by 2028. So the rising penetration of NEV will help China achieve its carbon neutrality target. Authorities in China are paying increasing attention to any possible weak links that could undermine the EV sector. So we expect more policy initiatives to shore up supply lines. Among the NEV manufacturers, we recommend BYD. Its NEV sales crossed 600,000 in 2021, a record high. Although its all-electric car sales volume is lower than Tesla, Tesla sold 936,000 BEV battery electric vehicles in 2021, and the also slightly lower than the sales of Volkswagen, but it was ahead of the Volkswagen brand, so it ranked the third in terms of all electric car sales. This is you can see in this table its sales volume last year. So new energy vehicle sold more than 600 million in 2021. It comprised 593,000 units of passenger vehicle. And among the 593,000 passenger vehicle, 320,000 came from battery electric vehicle (BEV), and 272,000 came from plug-in hybrid electric vehicle. Okay. BYD also sold new energy commercial vehicle comprising mainly bus and others. So last year it sold more than 10,000 commercial vehicle, and including 5,772 bus and 4,266 other vehicles. As for oil fuel vehicle, is shrinking. You can see year on year, it dropped by 42.5% to 136,000 units, whereas new energy vehicle increased more than 200%, from 189,000 units in 2020 to more than 600,000 units in 2021. Okay. This is a monthly sales record by BYD, and see it recorded 7th consecutive monthly record in December. Cumulatively, BYD now sold more than 1.5 million plug-in electric cars, including over 800,000 all-electric cars. Its 2022 NEV sales target is to double the volume from 600,000 to 1.1 to 1.2 million plug-in vehicles. That will include 600,000 electric vehicles and 500,000 to 600,000 plug-in electric hybrid electric vehicles, PHEVs. Okay. What is the key reason for success for BYD? The key reason is vertical integration. The success of its sales in 2021 is actually a result of the core technologies, including its blade battery, IGBT chips, and DMI is its latest plug-in hybrid system, as well as the all-new E-Platform 3.0. And on top of that comes the attractive design of new models. Okay, and for BYD, the good news keeps coming. It has received approval from the Shenzhen Stock Market authorities in August last year for the listing of BYD Semiconductor. And it has won the mining right of up to 80,000 tons of lithium ore in Chile. For battery EVs, the supply of lithium ore or metallic lithium is crucial for the development of the battery electric vehicles. And lithium metal spot prices, because of robust demand from car makers, rose as much as 175% in 2021, and entering 2022, lithium carbonate prices has risen to 316,000 yuan per MT. The securing of supply of lithium ore will help will be favorable to BYD in its development of battery electric vehicles, and it has entered a smart driving joint venture with autonomous driving startup Momenta to deploy autonomous driving capabilities across some of its car model lines. Okay, it has outperformed the market last year. Its share price has risen to as high as 324.6 Hong Kong dollars in late 2021. Currently, it was in a correction phase. So we reckon that this is opportunity for investors to come back and invest in the companies. We recommend buy at 238 Hong Kong dollars, and we have a target price of $290 for BYD, and the stop loss price would be 210 Hong Kong dollars. Okay. Today, I will also compare the three new forces, the so-called new forces in car manufacturing, namely Li Auto, NIO, and XPeng. Okay. XPeng delivered 98,155 vehicles in 2021. It took the top place among the three new forces last year in terms of vehicle deliveries. Its delivery was up 263% year on year, and since inception, it has delivered a cumulative total of over 130,000 vehicles. NIO came second. It has delivered 91,429 vehicles last year, up 109% year on year, and since inception, it has delivered a cumulative total of 167,000 vehicles, because it has earlier head start compared to XPeng and Li Auto. Li Auto delivered 90,491 vehicles last year, up 177% year on year, and since inception, it has delivered a cumulative total of 124,000 vehicles. So generally speaking, all the three car makers, Li Auto, NIO, and XPeng, they are in similar development trajectory at the moment. So we'll see which one will outpace the other two over the long run. In terms of revenue, NIO still leads over Li Auto and XPeng. We expect its revenue to rise to $5.6 billion in 2021, more than double that of 2020, and we expect a further increase to 9.8 billion in 2022 this year. As for Li Auto, its revenue is expected to increase to $4 billion in 2021 and to 6.8 billion this year. As for XPeng, the revenue last year was expected to be around 3.2 billion, a big jump from the 0.9 billion in 2020, and it will almost double to 6.1 billion in 2022. Okay. But having the fastest growth in revenue or the biggest revenue does not mean it's the most profitable company. So this chart compares the gross profit margin of Li Auto, NIO, and XPeng, and that of Tesla as well. You can see Tesla has the highest gross profit margin up to September last year. Its profit margin was 23.11%, followed by Li Auto, close to 20%, And then new gross profit margin came in at around 19%. And Xiaopeng is catching up. Its gross profit margin rising from single digit to low double digit. Last year, in the third quarter, last year, its gross profit margin was 12.3%. Li Auto's unique one core model, because Li Auto's very different from the other two manufacturers. It has only one model, that is the Li One model. But this focus on one core model brings efficiency and high margins to the company. In the third quarter to last year, its gross profit margin rose to 23.3%. Only slightly lower than Tesla's 26.6%, and higher than NIO's 20.3% and Xiaopeng's 14.4%. So this is the latest GPM data. Okay. As for net profit margin, all the three companies are still loss-making, are still losing money. With NIO seeing its net margin negative 20% net margin. Li is better because of the better gross profit margin, so its negative 12% net margin is the best among the all the three. As for Xiaopeng, its net margin was negative 17%. So these are the net margins in 2020. The figures have not come out yet for 2021. All the three companies posted deeply negative net margins, mainly because costs related to R&D and SG&A significantly outstripped the revenue growth. Okay. As for market cap, NIO still has the biggest market cap, $47.5 billion US, and followed by Xiaopeng. Xiaopeng was actually catching up fast. Now its market cap was close to $42 billion US, and Li Auto is the smallest among the three, with $30.9 billion US market cap. As for valuation, NIO and Li Auto are quite similar, trading at 4.8 and 4.6 times PS, price to sales, expected PE for 2022. This is the forecast PS for 2022. Xiaopeng is more expensive in a sense. It's trading at 6.9 times PS for 2022, but also we understand that companies that are trading at higher valuation is more valued by the market because of its growth potentials. Okay. Here, this chart compares the share price of the three automakers. You can see that before June in last year, NIO was the winner. It outperformed its share price outperformed that of Li Auto as well as Xiaopeng. But starting from the second half of 2021, we saw a clear sign that NIO was lagging behind. This is the and the margin is widening even further. Now it's a fight between Li Auto and Xiaopeng, and among the three, we like Xiaopeng better. We favor Xiaopeng better. New stock declined by about 41% last year, while Li Auto stock was down by 1%, and Xiaopeng was up by about 14% last year. So it also shows market's preference among the three automakers. Okay. As for A-share stock pick, this time we recommend Tour Pool Group. which is listed on the Shanghai Stock Exchange. The stock code is 601689. It's a technology leading automobile parts company focusing power chassis system, interior and exterior design, and intelligent driving control system. It's also an industry leader in the field of automotive NVH, stands for noise, vibration, harshness, that is capable of synchronizing design with OEM. So it's very flexible. It can design its product together with original equipment manufacturers by providing integrated NVH solution, accomplish vehicle tests for its clients, and analysis for its clients, design products accord with vehicle vibration and noise target. It mainly produces 5 series of products, such as anti-vibration system, interior and exterior system, automated driving system, chassis lightweight system, and thermal management system. It has become a global supplier for international car makers, including BMW, Benz, Audi, Porsche, Volkswagen, Chrysler, GM, Ford, Honda, Geely, and other car makers. It also cooperates with new Chinese car makers such as NIO, Xiaopeng, and Li Auto. Here is the financial highlights of Tuopu. It recorded operating revenue of 7.823 billion yuan in the first 3 quarters of 2021, up 81.1% year-on-year. Its net profit for the first 3 quarters last year was up 94.44% to 753 million yuan. Basic earnings per share also grew 86.49% to 69 fund. 69 fund. But there was a recall incident recently that investors have to take note. Tesla has applied because it directly supplied products to Tesla. Tesla has applied to recall about 22,500 Model Y vehicles in the US and in China due to the strength of front and rear steering knuckles on some recall vehicles may not meet design requirements, and those steering knuckles are directly supplied by Tuopu Group. Tuopu Group in a announcement stated that this recall isn't a major event as the probability of defects was about 0.2% to 1% and therefore will not affect the firm's annual operating performance. Okay, this is our earnings projection for Tuopu. We expect the revenue of the company to grow 79% in 2021 and 21% in 2022 and 16.2% in 2023, from 6.5 billion yuan to 11.6 billion yuan in 2021, and then increase to 14 billion yuan in 2022 and 16.3 billion yuan in 2023. Gross margins will also see improvement from 21.8% in 2020 to 22.1% in 2021, 22.6% in 2022, and 24.5% in 2023. ROE will also improve substantially from single digit to double digits, from 8.3% in 2020 to 12.3% in 2021, 13.9% in 2022, and 16.8% in 2023, as we expect the net profit to almost triple from 628 million in 2020 to 2.15 billion yuan in 2023. Okay. This is the share price movement of the stock. It has risen to peak of 68 yuan in late 2021, and then its share price corrected partly because of the recall incident, but it has bottomed out in December, between December and January. Now is on rising trend again. We recommend a buy price of 50 yuan and a target price of 60 yuan and stop loss at 45 yuan. Our target price is equivalent to 57 times price to earnings PE for 2021 and 42 times and 31 times forward PE for 2022 and 2023 respectively.
Now we'll be entering the Q&A section of this webinar. Lewis, over to you.
Quite a number of questions. This question from Sim Dan, he's asking about Tencent and AIA. Please share on Tencent and AIA. Here today, I will provide the analysis with chart technical analysis. So let's look at the share performance of Tencent. Tencent, its share price has has strengthened recently. So in the short term, we are upbeat on its share price. Expect its share price to be able, if it can hold above the 50-day moving average, which is $450. It will be able to test this resistance level of 495 because worries about regulatory concerns have eased recently. So we expect upside rebound in the valuation as well as the share price. We expect the share price to move in the range between 450 and 495 Hong Kong dollars. As for 1299, its share price has also rebounded very strongly in the last week, partly because of Fed rate hike will also be positive to AIA. But it met resistance at around the 250-day moving average, around $92 Hong Kong dollars level. And we saw a sell-off last Friday after rising to as high as $92. The rise in the last 2 days, the rally in the last 2 days was a bit too quick. So we expect some consolidation in the short term. We expect the share price to consolidate around 85 to $88 before making another attempt at the 250-day moving average. Technically speaking, it should hold about $85. If its share price breaches the support of $85, then it may be signs of weakening. Another factor that is key to its future its prospect is when the Hong Kong and China, the border will be open, so more mainland Chinese visitors can come to Hong Kong to buy insurance policies from AIA. That would be a key factor for its future earnings growth. Okay. Winston Lee said he is still holding Alibaba, Meituan, and Xiaomi with paper, I guess it's paper loss lah. Yes, with paper loss. Should I hold, buy, or sell? Okay. I think let's look at each of the tech stocks. Alibaba's share price has bottomed out around 109 Hong Kong dollars, and now is on an uptrend. We do expect its rebound has not been over. As long as if it can hold about $115, slightly below the 20-day moving average. If it can hold about 115, I would recommend to continue hold Alibaba with a short-term target of 135 Hong Kong dollars. So we expect the share price to move between 115 and 135. But next Monday there will be a Tesla, on all these tech stocks because of the sell-off on the US market last night, and ADR prices, Hong Kong stock ADR prices show that there's downward pressure on those stocks. But if those stocks can rebound very quickly from low week opening next Monday, so it would be also signs of a good signs that their share price are still on the uptrend. As for Meituan, I also think you can hold the stock for the time being, because its share price has bottomed out around 190 and now is on a uptrend. But we expect the resistance around the 100-day moving average, which is around $250. Yes, to break above 250 before it can move higher to test maybe the 250-day moving average around 280. So as long as it can hold above 215, the support level, we expect support level around 215 Hong Kong dollars. As long as it can hold above 215, I think, Winston, you can continue to hold Meituan. But for Xiaomi, we are not too upbeat about its prospect, because handsets itself, now the growth has stalled, and the market has become more competitive, with Huawei re-entering the market, and Apple also catching up, taking back some market share from Xiaomi. So I would advise you to sell into the rally. If share price can rebound to, say, around, now is around $19. If it can rebound to around 2050 Hong Kong dollars, 2050, I would suggest dispose of it and switch into another counter. Okay, what is your view on Hang Seng Tech ETF? Good to accumulate now. Let's look at the Hang Seng Tech Index first. The Hang Seng Tech Index has also bottomed out around 5,200. Now it has rebounded from a recent low, rebounded around 10%. But if we look at the relative strength index, the RSI, the momentum is not as strong as the Hang Seng. So we do expect there will be resistance around 5,900, and the other resistance level we expect will be around 6,150. So these are the two key resistance level. Next Monday, if the market open lower because of the sell-off on the US market last night, I think it may be a good opportunity to buy at a lower price if the index itself corrected to around 5,600. So this CSOP Hang Seng Tech ETF, Tech Index ETF, a suggested entry price would be the 20-day moving average. Currently is around 555 to 560, about 20 cents below the closing price of $5.79 last Friday. Okay, please. Okay, we've answered these three questions, and let's go down. Give me some time. I will. Okay, can you give your view on the Chinese banks for next 12 months? What will be your top 3 banks that we can put more focus on? Thanks for the question from Hannah. The outlook of the Chinese banks are brightening because of interest rate hike in the US, and also interest rate reduction in China, which we believe will also spur demand for loan demands, which will benefit the banks, the banking sectors. Actually, the share price of most of the Chinese banks have already responded to this. On average, they had risen about 10% from the recent low. Take China Construction Bank as example. Its share price has rebounded from around $5 to currently it's $5.90. More than 10%. It's risen by more than 20%. So share price has moved ahead of the expectation of interest rate. I mean, a more relaxed monetary policy adopted by the PBOC. I don't expect a lot of upside for the state-owned banks because they have already risen by between 10 to 20%. But for the commercial banks, we think they are still quite good upside. My top two, I would pick the top two Chinese bank. Among the top two I favor is China Merchant Bank. China Merchant Bank has saw a breakout recently, so I think it's still not too late to get into this stock. Its share price saw solid support around $59, and it has formed a rectangular pattern between 59 and 69. So now it has breached the resistance, is risen above the resistance of the rectangular level. If it can hold above $70, our target for CM Bank, China Merchant Bank, would be $79. So there's still more than 10% upside. Another Chinese bank, the other top two which we favor is Postal Saving Bank of China. Unlike the state-owned banks, which are only rebounding from recent bottom, actually its share price, you can see from here, is making new record high. So both CM Bank and Postal Saving Bank of China, they boosted more rapid earnings growth as compared to the state-owned bank. So I would recommend these two banks to go into, China Merchant Bank and Postal Saving Bank. The stock code of the Postal Saving Bank of China is 1658, and the stock code of China Merchant Bank is 3968. Okay. What is your view on the Nickel AM China EV ETF, the electric vehicle EV ETF? We are still upbeat over the long-term outlook of electric vehicle in China. Last year, total sales of electric vehicle in China amounted to more than 3 million vehicles, accounting for nearly 50% of the total EV sales in the world. So this year is expected to increase to 5 million. So there are still a lot, and the penetration rate of EV in China is still low, currently below 30%. So we do expect this penetration rate to keep rising. There will be more policy initiatives to support the industry so as to hit the target of set by the government regarding the penetration rate of EVs. But we also need to be mindful that competition in the industry is also getting more intense as there are more new comers. Just now, I have compared the 3 new forces in EV manufacturing, NIO, Xiaopeng, and Li Auto. It will be more competitive. But choosing the ETF, the EV ETF, I think is a good idea because it covers the whole value chain, the whole supply chain, from battery to car parts, to car manufacturing, and it also will cover the different car manufacturers. So it's more diversified. Overall, I think at the moment is the whole sector is undergoing a correction after the sharp rally in the last quarter of 2021. The long-term prospect is still promising. Okay, what is the right price to buy, sell, and cut loss on tech index, Hang Seng Tech Index ETF, as well as the other one is the Hang Seng Tracker Fund. Okay, 3033 just now I have slightly touched about the entry point, which is around 555 to 560. Near short-term target would be $6.10. Mid-term target is 650. So if you manage to buy around 560 and it can hit the target of 650, there's more than 10% return. The stop loss price would be, you can set the stop loss price around 510. If you buy 560, 510 would translate into a 10% loss if unluckily one has to cut loss. Okay, as for tracker fund, Hang Seng ETF, 2450 would be a good entry level. 2450, where the 10-day moving average lies, 2450. You can set the stop loss price at 2350 or 23 with a potential loss of $1.50 or $1. Our target, mid-term target would be, short-term target would be 2550. Mid-term target would be looking at somewhere here around $26 to $26.50. So about $2 upside after the sharp rebound recently. Okay, please comment on JD Health, Ping An Insurance. In Ping An, I think, okay, we have not commented on that yet. Link REIT and Alibaba. Alibaba, I've commented already. Now the regulatory concern, worries about more regulatory unfavorable policy has eased, so the share price will be in a rebound mode. Okay, let's look at JD Health. JD Health is also, the share price has also hit the bottom around $50, and now it has rebounded to $70. I think the rebound is a bit too fast, so it needs consolidation around $65, around the 50-day moving average. It needs to consolidate before moving higher. If it manages to break above the 100-day moving average, which is this black line, which lies around $70, 70 Hong Kong dollars. We expect the target would be $74 to $75. So in the short term, we expect its share price to consolidate around 65. And after consolidation, if we can break about $70, we'll be looking at another target of a high target of $74 to $75. For those who are holding this stock, we would suggest to place a stop loss at around $61 to $60. If it drops below $61 and $60, then maybe one has to consider stop cutting loss. Okay, Ping An Insurance, I think the outlook is also brightening. Rate hike in the US will also favor Chinese financial stocks, including the insurance sectors, and its share price have been dampened in the last quarter of 2021, mainly because of the debt crisis. in the property sector because it's invested and also hold the bonds of some debt-ridden property developers. That's why it drags on the share price. Now, since there's the Chinese property market is improving because of expectation of more supportive policies to support property sales, as property market accounts for almost 30% of Chinese GDP. So it's crucial for the Chinese government to roll out policies to support although the Chinese government may not be seen as directly bailing out those debt-ridden companies. Yet we do expect more relaxation on the property curb. That would favor not only the property developers but also insurers that are highly exposed to the property sector, such as Ping An. In the midterm, we expect a share price to be able to rise to near the 250-day moving average, which is around $72. So we had a midterm target of 70 Hong Kong dollars for Ping An. Okay, Link REITs. Link REITs, I think we are neutral because the Omicron, the outbreak of Omicron is still having hangover on the local consumption as well as REITs on the REIT sector. There may be continuous downward pressure on rental renewal that would not favor Link REIT. So the recovery will be slower than expected, and we expect the share price to continue in this pattern, this sideways pattern between $65 and 71 Hong Kong dollars. Now it's trading about 10% below its NAV. Its NAV now is about 76 Hong Kong dollars. So now at 68 dollars, you are buying at 0.9% P book. But I think it's worthwhile to wait for a lower price, say more closer to the this sideways pattern, to the lower end of the rectangular pattern, which is around between 65 to 66 dollars, and then one may take profit when the price of the REITs rises towards 70 and 71 dollars. Okay. BY Ang asked if I have other recommended buy in new NEV, as BYD's minimum lot size is 500 and each buy will cost close to 23,000 Sing dollar, which poses high risk to small investors like him. Okay, so I think you may also consider just now among the three new forces, you can consider Xiaopeng. Xiaopeng, let me see the lot size. Xiaopeng's lot size is 100 shares per lot. So at 174.6 Hong Kong dollars, the one lot size will cost about less than 20,000 Hong Kong dollars. That's about less than 4,000 Sing. So I would suggest Xiaopeng if you think the entry barrier, the entry level for BYD is too expensive, too costly for small investors. Okay. Which sectors do you expect to outperform in 2022 and underperform? We are upbeat on three sectors. The electric vehicle we think will still be able to outperform in 2022. The other sector will be green energy, renewable energy. Stocks such as top picks among this sector would include CR Power, 836. Okay. H36 outperformed the market last year. You can see the rally was a very strong rally. But after the rally in the last quarter of 2021, now is in a consolidation correction mode, correction phase. So actually, we think this is also a good opportunity for investors to buy when its share price corrects. Recommended entry level would be around 20 Hong Kong dollars, which is actually the recent bottom. The share price sees support around between 19 and 20 dollars. So renewable energy as well as electric vehicle, these two sectors we expect will outperform in 2022. Another sector would be infrastructure related sector, such as the construction companies. Actually, the share price has risen quite a lot last year. You see, China Railway. As the economy continues to slow down, I think the Chinese government would spend more on infrastructure to both old infrastructure as well as new infrastructure to support the economy, to stimulate the economy. So construction company as well as cement manufacturers, CNBM and Conch Cement may also benefit from more infrastructure spending as well as an improving property market. The cement sectors, in terms of valuation, are also very cheap. Conch is trading in mid single digit PE, around 6 to 7 times, and CNBM is even slightly cheaper, trading at between 5 to 6 times PE and yielding more than 5%. So these are the three sectors we are upbeat about: the EV, renewable energy, as well as infrastructure related industry. Okay, any thought on Ping An? Just now we have explained that now as a proxy to the property market, as the property market is improving, so Ping An will see better prices, better performance on Ping An. Okay, and also US Fed rate hike will also be favor insurance companies. Okay, Razer. Okay, Razer, a lot of there's talks of privatization at $4, but it's rumor. So before when there was rumor of privatization offered at $4, its share price shot up to 3.1. But subsequently, there was a private privatization offer, but only at 280. And looking at the discount of the share price to the proposed privatization price, we are worried that there may be objection from other shareholders, so the privatization may not go through. So that if the privatization fails, there may be a downside risk we have to take note of. Support would be around 210, 215. So for those still holding Razer, please take note of the support level at 215, and resistance will be around 245. So we expect the share price to trade between 215 and 245 for the time being. In terms of results, actually the company results is okay lah. You can see that the earnings growth and the results are okay, but the share price is like roller coaster, which is not really linked to the results. So this stock is quite volatile. Okay, as you are approaching 12:30, I may answer 3 more questions. Hang Seng, Hong Kong EX seems hit bottom. What the TA in my opinion? Okay, let's look at Hong Kong EX 388. Yes. Oh, sorry, this is 388. Okay. The share price has formed a double bottom around 430. Now its share price is testing the leg line. The leg line would be around 480. So if it manages to rise above the neckline to breach the resistance of the neckline at 480, hold above that, and we are looking at from a TA point of view, the target would be another $50 upside that would bring it to 530. That would that means its share price would be rising towards the peak in last July, okay, which is still below the record price of $577 seen in early 2021. So 480, then 530. Okay, but it also hinges on the IPO market, whether it's able to hit the $530 target will very much hinge on the IPO market this year. Last year, yes, a good start in 2021. First half was good, but then second half, the IPO market lost steam. And recently, Hong Kong is expecting the first SPAC, SPAC. So if SPAC takes off in Hong Kong, which helps the turnover of Hong Kong EX, will also be favorable to the valuation of Hong Kong EX, but it depends on the IPO market and also the performance of the SPAC. Okay. Can comment on AI play SenseTime, a new AI player, AI listed last year. So its share price, it was listed at around 385, and then because of the euphoria about AI, the share price shot to $9.70 just within a few days after listing. Because of the sharp rally, so now I think it's in a consolidation mode to consolidate and correct after the sharp rally. As long as it can hold above $6, our strategy is we can make use of this consolidation mode. By around 660. The target, short-term target, you can set at $7.70 to $8. And if it breaks below $6, sorry, then cut loss. A loss of about 10% if it drops below $6. Otherwise, you can trade as this consolidation phase goes on. But after the consolidation, if it completes the consolidation and breaks about 850, which is another key resistance level, then we expect it will be able to test the record high of 950 to 970 again. Now is still in a consolidation mode. Okay, so one last question about Ganfeng Lithium. Ganfeng Lithium, a lot of good news about the company, which are released in the last quarter, yet the share price failed to rise despite the abundance of good news. So I think the market is worried about its move into buying the lithium mines overseas in Argentina at a very hefty prices, and lithium prices may not forever rise or forever be able to keep at the current high level. So there's worry that it's acquiring those lithium mines at too high prices. So in the short term, I think the share price has dropped below all the 250-day moving average. So it's still on a soft patch, the share price. We expect the share price to trade between 110 to 127. So this is the expected price range for the stock. But if it drops below 109, there may be further downside. It would not be a good signal if it drops below 109. Okay, so thanks for your time. I look forward to meeting you again in the second quarter and give you more updates about the Asia market as well as the Hong Kong market. And hope the stock tips this time will be able to help you make profits. Thank you.
Thank you so much. Thank you to our US analyst team and Mr. Louis Wong for their presentations. We have now come to the end, and I would like to thank all of you for joining our strategy and stock picks webinar. Please do take the time to fill in the survey so we can improve your experience with us in the future.